You're about to retire. You've got $500,000 invested. You meet with a financial advisor. They say they'll manage your portfolio, give you behavioral coaching, and optimize your strategy. Their fee? 1% per year. That sounds tiny. It is not. By the time you die, that 1% will have cost you $340,000. Not from losses, not from bad picks, from fees. And here's the thing nobody tells you. That money was already supposed to be yours. The financial industry has convinced us that we need a professional to manage our money. And they charge a price that sounds reasonable, 1% of your assets under management per year. 1%. That's $40 per 5,000 you have invested. Sounds fair, right? So if you have $500,000, your advisor gets $5,000 a year. Every year. Most people look at that number and think, okay, that's my cost of doing business. But that's where the math breaks down. The problem is you're not just losing $5,000. You're losing the compounded growth on that $5,000. Forever. This is called opportunity cost, and it compounds. Over 30 years, 1% in fees doesn't cost you $5,000 a year. It costs you $2.1 million. That's not an expense. That's wealth destruction, and the industry knows this. They just count on you never doing the math. Let's work through the actual numbers so you see exactly what you're giving up. You have $500,000. A financial advisor manages it. The market's returned 10% gross. That's $50,000 in market gains that year. But before you see that $50,000, the advisor takes 1%. That's $5,000. Your net return? 9%. $45,000. Feels like you gained money. You did, but you lost $5,000 to fees. Now here's where most people stop the calculation. They think, okay, so my cost is $5,000 a year. That's reasonable. But that's not how compound growth works. In year 2, your portfolio is worth $545,000. Your 10% market return is now $54,500. But the advisor still takes 1%, now $5,450. The gap between what you earned and what the fee cost you just got wider. By year 10, your portfolio is valued at around $1.1 million. The 1% fee is now $11,000 per year. By year 20, you're paying $23,000 per year to your advisor. You've given them $190,000 total, and you're still paying. Now let's look at the real damage. The difference between growing at 10% and growing at 9% year after year. $500,000 at 10% for 30 years inked $8.7 million. $500,000 at 9% for 30 years, $6.6 million. The difference, $2.1 million. Over 30 years, you've paid roughly $340,000 in actual fees. But the lost growth is $2.1 million. That's generational wealth. That's the difference between leaving your grandkids a comfortable inheritance or nothing at all. But wait, the financial industry has a defense. They say advisors are worth the cost because they add value through tax planning, behavioral coaching, and rebalancing. That's actually true. They do add value. The question is how much value? Vanguard did a famous study called Advisor Alpha. They asked, what does a good advisor add in value annually? Their answer? About 3%. 3% sounds like a lot. But remember, that's the value they add. You're paying 1% in fees. So on paper, you're ahead 2%, right? No. Here's why. First, that 3% assumes the advisor is actually good. Most aren't. Morningstar's research shows that most financial advisors underperform index funds, even before their fees. Second, that value is already baked into stock market returns. When you hold a diversified portfolio and rebalance annually, you're getting most of that behavioral and tax value automatically. But there's a third option the industry hopes you never discover: robo-advisors. Robo-advisors like Betterment or Wealthfront charge 0.25%. That's 1/4 the cost of a human advisor, and they deliver the same returns because they use the same index funds and rebalancing algorithms. On your $500,000 portfolio, Betterment costs you $1,250 a year. Your human advisor costs $5,000. Same strategy, $8,750 less per year. Over 30 years, that's $262,000 in savings, just from using a robot instead of a human. And if you just buy an S&P 500 index fund and hold it, like Vanguard's VOO fund, the expense ratio is 0.03%. That's 3 basis points. On $500,000, that's $150 per year. $150 a year to own the entire stock market versus $5,000 to have someone pick stocks. The math is brutal. But here's the honest part. There are situations where a financial advisor is actually worth the cost. Situation number 1. Complex tax situations. If you're self-employed, or you have significant business income, or complicated rental properties, or employee stock options, a good advisor, really a CPA, can save you more than they cost. A CPA might save you $20,000 a year in tax optimization. That's worth 10% of your portfolio's fees. Situation number 2. Large inheritances or complex estate planning. If you're inheriting $2 million and you have kids and you want a trust structure, a good advisor coordinating with an estate attorney is worth it. They might save you $300,000 in inheritance taxes. That's permanent. Situation number 3. You panic sell during crashes. This is behavioral. During the 2020 stock market crash, about a third of retail investors sold near the bottom. If you are that person, if a bear market would cause you to liquidate your entire portfolio, a human advisor might save you by being a guardrail. They'd literally prevent you from making a catastrophic mistake. Outside those 3 situations, an advisor is likely a cost, not a benefit. And I'm not saying this to be mean. I'm saying this because the industry counts on you not knowing the math. Most retirees don't have 30 years. You have maybe 20. Let's redo the math on a realistic timeline. You retire at 65 with $500,000. You need that money to last until 85, 20 years. That's about 240 months. If you're not working, you don't have the luxury of time. $500,000 at 10% for 20 years. $1.3 million. $500,000 at 9% for 20 years. $1.18 million. Difference, $120,000 lost to the 1% fee over 20 years. That's not a rounding error. That's the difference between a comfortable retirement and a tight one. And remember, the advisor is taking roughly $100,000 in actual fees over those 20 years. The lost opportunity cost is another $20,000 on top. Still think 1% is cheap? Now, here's where financial advisors push back. They say, but our value isn't in picking stocks. Our value is in keeping you from making emotional mistakes. We're worth it because we keep you disciplined. And you know what? They might be right. But if that's their main value, behavioral coaching, why does it cost 1%? Why not charge a flat $500 a month? Or $1,000? Why does it scale with your portfolio size? If you're getting behavioral coaching, the value doesn't change based on whether you have $500,000 or $5 million. The coach is the same. The conversation is the same, but the fee is 1,000 times higher. That's not pricing for value. That's pricing for extraction. And here's the thing. You can get behavioral coaching for free. It's called a forum or a YouTube channel, or a personal finance community online. You can also do what most people who build wealth do. Rebalance once a year, stay the course, and ignore the noise. That's not sexy. That doesn't fill an office with $50,000 desks. But it works. So here's what to do. Make this decision before you retire. Step 1. Honestly assess whether you're in one of those 3 situations. Self-employed or complex income? Complex estate? Or do you panic sell? If the answer to all 3 is no, skip the advisor. Step 2. If you decide you do want some professional help, ask yourself, what am I actually paying for? If it's stock picking, don't. Robo-advisors beat most advisors. If it's tax planning, hire a CPA, not an AUM advisor. CPAs charge hourly. You get a clear price. If it's behavioral coaching, you can get most of that from a cheap robo-advisor. Step 3. If you're going to use an advisor, get it in writing. Ask them, what is your specific plan to beat the market? If they can't answer that clearly, or if the answer is behavioral coaching, negotiate the fee. 1% is industry standard. It's not a law of nature, it's a price point they chose. Many advisors will negotiate down to 0.5% if you ask. That cuts your 30-year fee cost in half. Step 4. The easiest path for most people? Open a Vanguard account or Fidelity account and buy a low-cost index fund. Put it on auto-rebalance once a year. Done. VOO or VTIE for stocks. BND for bonds. Done. Your expense ratio, 0.03 to 0.05%. Your psychological cost, 5 minutes a year. Your 30-year cost, somewhere between $5,000 and $10,000. Not $260,000. Not $340,000. $5,000 to $10,000. The difference between the cheap option and the financial advisor option is roughly $300,000. That's your actual choice. I get why people like advisors. It feels good to have someone in your corner, someone who's looking out for you. But looking out for you while charging 1% of your assets is a conflict of interest. The bigger your portfolio gets, the more they earn. That's not aligned with your interests. It's a business model, not a partnership. If this video helped you, hit subscribe. We talk about the math that the financial industry has been hiding from you.